Amazon of finance. When you look at the recent market carnage, it is easy to lose sight of the signal, but the first undeniable essence of this story is the certainty of 30% compounding growth, a metric that management has not only guided for, but is executing on with precision by targeting 30% compounded annual revenue growth and 38 to 42% EPS growth through 2026. Very few companies in existence can claim this level of durable growth under all economic conditions, yet SoFi just delivered its first billion-dollar quarter and reported record member additions, proving definitively that it grows even when the broader sector struggles or stagnates. This leads us directly into the second essence, which is the end of the 1960s banking era. Because just as Amazon destroyed the concept of driving to the mall to shop, SoFi is systematically dismantling the concept of driving to a bank branch to manage your money. We do not dress like it is the 1960s. We do not travel like it is the 1960s. And we certainly do not consume content like it is the 1960s. So there is absolutely no reason why we should still bank like it is the 1960s. By consolidating everything from crypto and IPO investing to personal loans and high-yield banking into one single, seamless app, SoFi is building a Prime-like ecosystem that locks users in and keeps them there, ensuring that the Amazon flywheel of finance is finally spinning at a velocity that legacy competitors simply cannot match, creating a moat that is widening every single day while the market remains distracted by short-term price fluctuations. The entire narrative shifted instantly on February 4th, 2026, with a massive game-changing upgrade from JPMorgan that serves as the institutional validation we have all been waiting for, effectively signaling that the smart money is finally waking up to the reality of the value proposition here. JPMorgan upgraded SoFi from a neutral rating to an overweight, which is a screaming buy signal, and slapped a price target of $31 on the stock, representing approximately 40% upside from current levels. But what is even more important than the number is the reasoning behind it. JPMorgan explicitly stated that the recent post-earnings drop created the exact entry point they had been waiting for, signaling that the weakness was not a fundamental breakdown, but a tactical opportunity for institutional accumulation. While other fintech companies are currently suffering from deposit outflows and stagnant growth, SoFi is seeing record inflows and business momentum that completely separates it from the rest of the pack, driven by material GAAP earnings and a business model that is proving to be resilient in the face of macro headwinds. This upgrade does not stand alone, however, as it completes a bullish trifecta of major analyst targets that are all sitting significantly above the current share price, with Mizuho projecting $38, Needham targeting $33, and now JPMorgan anchoring the thesis at $31. This consensus among top-tier analysts confirms that the disconnect between the stock price and the underlying business value has reached an extreme, and the fact that a conservative powerhouse like JPMorgan is willing to step in and call this the bottom is likely the catalyst that will reignite confidence in the retail sector and force short sellers to reconsider their positions before the stock moves aggressively toward these new price targets. There is a hidden signal in the market that the retail crowd almost always misses until it is too late, and that is the institutional cost basis, specifically looking at where the big money has actually been putting their cash to work rather than just listening to what they say on television. When we dig into the filings, we see that major funds are not just watching SoFi from the sidelines, they are aggressively buying the dip, and interestingly, they have paid significantly more for their shares than the price you can buy them for today. For instance, Federated Hermes increased their stake by a staggering 1,383%, with an estimated cost basis of around $26.44, while mutual advisors boosted their position by 704%, with an estimated cost basis of roughly $28.10. This data reveals a massive opportunity because it proves that these institutional giants loaded up in the $26 to $28 range, meaning that with the stock trading around $21.76, you are getting a massive wholesale discount compared to the smart money. If these sophisticated investors with billions of dollars in research capabilities love the stock at $28, you can be absolutely certain that they are not selling down here at $21, which suggests that the strong hands are holding firm and likely accumulating more. This creates a supply constraint where the float tightens up, and as demand returns, the price has to move up through these institutional ownership levels, making the $26 level a magnet for price action as the market eventually seeks to realign with the valuation that these large funds have already committed to with their capital. Now we must turn our attention to the technical analysis, because the charts from February 3rd, 2026 confirm that the turnaround is technically set up and ready to execute, validating the fundamental thesis we just discussed. On the intraday chart, we witnessed a classic V-shaped recovery where SoFi bounced hard off the low of $21.02, effectively establishing a critical floor of support at the $21 level that buyers are fiercely defending. This price action was accompanied by a shift in momentum as the MACD on the 10-minute chart posted a bullish crossover and the RSI reset to a neutral 54.50, giving the stock plenty of room to run to the upside without being overextended. The immediate battleground, or the gatekeeper level, is the major resistance at $22.80, which corresponds with the daily 200-day simple moving average and aligns perfectly with the Citizens Analyst price reference. A sustained break above this $22.80 level is the key that unlocks the entire trade, because once the ceiling is cleared, an air pocket opens up directly toward the institutional buy zones of $26, with the ultimate destination being the JPMorgan target of $31. In summary, the recent market carnage has created a rare and profitable disconnect between price and value, defined by 30% compounding growth fundamentals, a massive catalyst in the form of the JPMorgan upgrade, a safety net provided by heavy institutional buying at higher prices, and a technical setup bouncing off solid support. The verdict is clear. The essence of SoFi is stronger than ever. The drop was a gift to those paying attention, and the climb to $31 begins right now. In my opinion, SoFi currently represents one of the most asymmetric risk-reward setups in the entire market. The disconnect between its current $21.76 price and its intrinsic value is stark. While the market has been distracted by short-term carnage, SoFi has quietly solidified its status as the Amazon of finance, locking in 30% compounded growth and record GAAP profitability. The February 4th JPMorgan upgrade to overweight with a $31 target is the pivotal catalyst that changes the psychology of this trade. It confirms that the drop to $21 was not a fundamental breakdown, but a tactical entry point for smart money. Technically, the V-shaped rejection of the $21 lows establishes a massive floor, and a breakout above the $22.80 resistance seems inevitable. Most importantly, the fact that major institutions like Federated Hermes aggressively loaded the boat at prices above $26 means retail investors are currently getting a wholesale discount relative to Wall Street. The bottom is likely in. The climb to $31 has begun.